Bitcoin just hit $70,000. And by the end, everybody's going to see that this rally is absolutely fake. 6 billion has just left the market and trading volume has absolutely collapsed. And there's one chart that should terrify everyone that nobody is seeing right now. So I'm going to tell you the 3 reasons why this rally is fake. And by the end of the stream, you're going to have a complete understanding as to why you should be cautious during this Bitcoin start of the run up. But first, let's get into the main reason here why we are seeing Bitcoin potentially run up after passing $70,000 because everybody sees Bitcoin up 4% today. $70,000. Green candles everywhere, right? You go on Twitter, you go on YouTube, and people are posting their gains saying, "We're back, baby," calling the bottom. And look, I get it. After the beating this market has taken since last October from 126,000 all the way down to 60K, seeing green really feels good. And I'm not going to pretend like I'm not happy to see this rally going up, but I need you to do something for me right now. I need you to stop looking at the price for a second because the price is telling you one story and the data underneath is telling you a completely different one. Here's the first number, right? We're seeing spot trading volume down. Now, if we scroll on down in this link, they're going to show you and tell you that the market liquidity is still at a bottleneck, right? Spot trading across volumes is about 25 to 30% down from 2025 numbers. And this isn't me saying this, right? This is Kaika, maybe. I don't know if I'm saying that correctly, but it's one of the more respected data providers in the Bitcoin space. And now they're saying 25 to 30% of that volume is just absolutely wiped out. So what does this mean in plain English? It means that there are significantly fewer people in the market right now than there were 3 months ago. Fewer buyers, fewer sellers. And when you have a market with way fewer participants, the price becomes really easy to push around, right? Because a relatively small amount of buying pressure can move the needle way more than it should. And that's exactly what you're seeing today. Think about it this way. Imagine you're at an auction. If there's 500 people in the room bidding and the price goes up, that means something. That's real demand. But if there's 50 people in the room and the price goes up by the same amount, does that mean the same thing? No, it means the room is empty and a couple of aggressive bidders are pushing the price around. That's Bitcoin at $70,000 today. The room is still empty. And I'm not the only one saying this, right? It's Coinbase and or CoinDesk, excuse me, lining this out for you here because look, they're not a Bitcoin bear publication by any means, but they published an article today about this rally. And here's what they said in here. So I'm going to tell you guys so you don't have to go through and read all of this. They said there's thinner trading volumes are supporting the current rally during the weekend and seller exhaustion. So let me unpack that. The thinner trading volumes, that confirms what I just showed you. The market is thin and seller exhaustion is the key phrase here because essentially the whole narrative of this bear market has been that the whales and the Bitcoin IPO moment. I mean, I've had Jordy Visser on the show and I've kind of broken that all down for you guys, but essentially Bitcoin's IPO moment is essentially lining out that the early whales came in and they were selling like madmen. We've actually never seen selling pressure this high. And in fact, because Bitcoin's price didn't collapse to 8,000 like people are saying for Michael Saylor and Strategy, because Bitcoin didn't collapse that low, I actually think that was extremely bullish for what we've seen. But let's get back to the point at what CoinDesk is saying here, because seller exhaustion does not mean the buyers showed up. Seller exhaustion means that the people who wanted to sell have already sold. So they're out. They've tapped out. So the price is going up not because there's a flood of new money coming in, but because there's nobody left to push it down. These are two completely different things. If you showed up at the gym and lifted weights because the weights was lighter, you didn't get stronger. The weight just got lighter, right? That's what's happening here. Bitcoin didn't rally because demand came back. Bitcoin rallied because the sellers have ran out of coins to dump. And by the way, this is a weekend. It's Saturday. The institutions aren't trading. The hedge funds aren't at their desks. And the market makers have reduced activity. So this is the thinnest liquidity window of the entire week. And that's when this quote breakout is happening. So it's convenient, right? But the volume is just the first number. The second one that I'm about to show you guys is a little bit worse and a little bit more, let's say, just scary here because we've seen ETF outflows that have added up here. And this is where I've been covering, and I just had a podcast with British Hodl who said 94% of these ETF holders have held, which is great. But we have seen the first time since these ETFs have come out, we've seen consecutive months of ETF outflows. So this is case in point for a bull trap, let's say, because since November 2025, the investors have pulled out approximately $5.7 billion out of these spot Bitcoin ETFs. And that was just through January, right? These outflows have continued into this month of February, and the total is now at 6 billion or a little bit more. So 6 billion has left all these ETFs in 3 months, and that's the longest sustained outflow streak since these products have been launched. Now, let me give you some context on why this is such a big deal, because remember in 2024 when the Bitcoin ETFs launched, that was supposed to be the moment. BlackRock, Fidelity, ARK, all these big guys in finance came in and they were giving their clients access to Bitcoin through regular brokerage accounts. And it worked. Let's be honest. Like, we saw massive amounts of inflows for a long time, billions poured in. And Bitcoin went from 40,000 about to 126,000. And everybody's like, oh, it's here. Institutional adoption. We're going to get the big players. We are never going down again. Yet the total ETF holdings are down. And it's across the board. It's not just one specific ETF. It's at a 4-day losing streak. And the rate cut outlook isn't looking positive. And the total ETF holdings are down almost 100,000 Bitcoin. That's a significant amount, folks, from their peak in October 25. So 100,000 Bitcoin, that's not anything to frown at. $7 billion worth now at this point. And that institutions have taken it off the table. This is not trimming of the position. This is rebalancing of the portfolio. And the institutions are heading for the exits, unfortunately. And here's where this gets put really into perspective. I think, Goldman Sachs did a little nice, reveal here when they kind of put it there, because they've shown that they've had 45% of unrealized losses. So these institutional players were buying the tops. Now, it takes a while for these institutions to get in on, these holdings. And because it takes a while for them to get in, and, they're one of the more powerful banks on the planet, and they hold 13,700 Bitcoin through these spot ETFs. Right now, they're sitting on that 45% unrealized loss. And this being underwater is not exactly a positive for things that they're trying to continue and up this position, right? If Goldman Sachs is sitting on this much, and what did they do last quarter, right? They cut their Bitcoin ETF holdings when they're underwater. I mean, that's just reality. Is these money managers, they hammer their winners and they pull out of their losers. And look, I'm not trying to say that Bitcoin is dead. It's over. But the reality is when institutional money comes in, they look everything in fiat terms, in dollar terms. And let's just face the reality here, folks. Bitcoin has been a loser for them in this short term. Now, obviously, they still believe in Bitcoin in the long term. This is why they're still holding Bitcoin, but they trimmed their position by a significant amount, by 39.4%. So they didn't buy the dip. They didn't do dollar cost averaging on the way down. They sold 40% of their position. So Goldman Sachs is not accumulating. They're trying to stop the bleeding. And Goldman Sachs, let's just face it, they aren't alone. These entire institutional complex keep pulling back. These ETF holdings are cratering. The AUM of these ETFs has almost been cut in half. So money is flowing out every single week, and Bitcoin rallied to 70,000 on a Saturday with no volume. And people think we're back. That's the interesting part of all of this, because The smart money is leaving right now. Well, okay, I'm putting smart in quotation here, folks, but it could happen again. Now, here is another factor here because on February 5th, that's when Bitcoin hit $60,000. Now, everybody was kind of saying this is where, it's the most talked about aspect of it is the liquidity, right? Most of YouTube's finance committee looked at that day and said retail got wrecked on February 5th, right? Because there was a lot of bad beats. They got liquidated. The market flushed them out. That's when Bitcoin fell to 60K. But, we had Jeff Park of Bitwise kind of break it all down. And he's a friend of the program, been on the show before. But he basically said that, and Bitwise, for those who don't know, is one of the biggest crypto asset managers in the world. Look, I mean, they have Bitcoin, they have ETH, they have these other things, but obviously I'm a Bitcoin only guy. But I mean, I think his perspective as an institutional money manager is very interesting because it's not retail. It's saying this. It was TradFi, traditional finance, saying that behind the scenes that multi-strategy hedge funds, we're talking about firms like Millennium and Citadel and some of these big firms that manage tens of billions of dollars, they had built up massive positions in what's called a basis trade. So let me explain what this is because it's really important and I didn't fully understand it until I started really breaking it all down. But here's what's going on. You buy spot Bitcoin, or in this case, the Bitcoin ETF, and at the same time, you short Bitcoin futures. And when there's a premium between the futures price and the spot price, you pocket the difference. It's supposed to be a low risk arbitrage. You're not betting on Bitcoin going up or down, you're betting on the spread. So, that sounds safe, right? It is until it isn't, right? I mean, we saw this Japanese carry trade and the basis trade essentially collapse a couple years ago. And that's when I had Jack Mallers on the podcast back in, I think it was August of 24. Um, and the Japanese yen carry trade almost collapsed the whole market. That was the third biggest move we've ever seen in the market, and all Japan did was raise the basis points by 25. you know it's crazy that little move created such chaos, but this is what we're seeing going on in the Bitcoin market, kind of similar, right? Because when the market moves fast against you and the spread blows out, you have to put up more collateral. And if you can't, you are a forced seller and you need to unwind that trade. And unwinding means you're selling your spot Bitcoin to cover your future shorts. So selling the spot in a failing market. And that's exactly what happened on February 5th. These massive multi-strategy funds were forced to sell the spot Bitcoin ETF to unwind their basis trade. And they weren't panic selling because they lost faith in Bitcoin. They were mechanically forced to do it. They were playing these fiat games to try to leverage and get more Bitcoin. And that's the cascade of being a forced seller, right? And this is where I think it's really important for all of you guys here in the audience here, because I mean, you never want to be a forced seller. And the reality is sometimes we need a little bit of liquidity. And this is why I've partnered with Salt Lending, because they are the best place where, in my opinion, where you can unlock that liquidity without needing to sell. You go to saltlending.com/green-candle. They're going to give you guys some of the best rates in the industry with 9.95% with durations of 1, 3, and 5 years, 70% LTV. But the reason why I like Salt so much is they got this Salt Shield. So unlike these traditional hedge funds that got liquidated when the price went down and there were forced sellers, you can get the Salt Shield and you don't have to be a forced seller. I mean, I know a lot of these other Bitcoin lending programs that have caused people to be forced sellers, and this is why I've partnered with Salt, because I think that the Salt Shield is a great tool. But let's get back to the matter at hand here, because I think this is a little bit of a the February was a bear trap and a bull trap in a sense, right? Because this is what has triggered everything. There's been some unique outlook on Kevin Warsh, right? I mean, Donald Trump has brought in a new Fed chair, or as nominated one. It's not official yet, but I think the reason why we've seen all this is this belief that Kevin Warsh is going to be very hawkish, right? Because he's a former Fed governor who's been nominated to replace Jerome Powell. And he's made comments suggesting that the liquidity could remain constrained and borrowing cost would stay elevated longer than expected. And people are calling it the worst shock. When borrowing costs go up, obviously, leveraging trades like the basis trade become less profitable. And when they become unprofitable, they unwind violently. And so now here's the part that should really concern you, because these conditions that we've been having, high borrowing cost, constrained liquidity, thin markets, they haven't changed at all. There's been nothing that has been resolved. The same forces that caused the February 5th crash are still in place. So this basis trade hasn't fully unwound, and the leverage hasn't been flushed out of the system just yet. And that's where I think it's going to get interesting, because we're even having traditional media cover this. CNBC, the bears over there, they're always questioning Bitcoin and if it's going up, if it's going down. They wrote about how on February 5th, the sell off was triggered by a wave of liquidations that had a cascading effect, which exacerbated the selling. This isn't conspiracy stuff, right? This is the mainstream financial media explaining the mechanics of what happened. So we're sitting here today with Bitcoin at around 70,000, just under at the time of this recording. And the exact structural risk that caused the crash 2 weeks ago is still loaded in the system like a spring, folks. All it takes is just one more shock, one more Warsh style comment, and one negative surprise, and we could see some kind of forced selling all over again. And that brings to the chart that I mentioned at the very beginning here, because this is where I think it's going to get really, really interesting, to say the least, because, we're starting to see how, the liquidations are going to start to trigger, right? And it's going to force a liquidation spiral. And I think that this is going to come out here really quickly, because now when we start to see and Bitcoin, kind of come out, this is going to seem like it's going to start to pull out extreme turbulence, which I think is going to be very, let's say, worrisome, to say the least, right? Because this tripwire could sell off and it could be a fault line for Bitcoin. A sustainable break below it could quickly escalate the volatility rather than produce a normal correction, which normal for Bitcoin is already pretty volatile, to say the least. So let's walk through what we're sitting at, right? Because there's multiple things stacked on top of each other at this one price level, and together they create what is essentially a financial trapdoor. The first is the options market. There's a big cluster of bets in Bitcoin's entire options market right now, that are contracts that pay off if the price falls below 60K. And this is from Deribit, which is like the largest crypto options exchange in the world. So, I mean, this is not somebody that is, just a chart bro like me with a shit haircut and a funky mustache or anything like that, right? So when you have this much open interest on one price level, it creates what's called a magnet effect. And market makers who've sold those puts need a hedge to their exposure. So how are these guys hedging? They're going to sell Bitcoin. The closer they get to that price of 60K, the more they have to sell. It's self-reinforcing. The next thing is that 200-week moving average. We've got the bros who have been, essentially going down. And all of these things, right, essentially have been looking at as these, right, the power law. Everybody's been equating it to all of that. But at the end of the day, there is something interesting with this, right? Because the 200-week moving average, for those who aren't technical traders, and look, I'm not, but the 200-week moving average has almost been taken as the gospel, right? It's a line that the chart represents the average price of Bitcoin over roughly the last 4 years, right? So it currently sits just above $58,000. And in Bitcoin's entire history, this level has only broken during the absolute worst moments. The bottom of the 2018 bear market, the 2022 bear market after the FTX collapse, and that's it. So, I believe it's only been in 4% of all of Bitcoin's history has it fallen below this 200-week moving average. So that's another interesting tidbit. So if we fall below that, that'll be all falls down, as Kanye West says. But the third is these Bitcoin backed loans. And look, I mean, this is why I like salt lending. And this is why I tell you guys to go through, and get that salt shield, because a lot of these lending programs have come out within this past couple years. And I get it. You need to have some of your liquidity. But I think it is a very dangerous spot to be borrowing at the tops. And that's essentially what we saw. A lot of people borrowing at 126,000. I personally think right now, look, and it's not financial advice, but right now, borrowing towards the bottom, this is a place where if you think we're at the bottom, it would be a better place to buy, because if we go up, then your loan to value will shrink, thus making your loan interest rate better for you, the borrower. So I think a lot of people borrowed at the top, and these Bitcoin backed loans, we've seen billions of dollars in loans that were collateralized, and the price fell, and it triggered these borrowers to either have to put up more Bitcoin or the lender to sell the collateral. And that created more of a selling pressure, and more selling pressure pushes the price down further. So more margin calls get triggered, and yeah, you see where all this is going. So then you put this all together, and then we get the Economic Times of Australia and others having article headlines like this, where essentially they're saying, hey, look out, we're going down. I'm yelling timber, folks. But one analyst put the number on it, and I quote, a sustained break below the critical 60,000 to 58,000 zone would likely open the door to a deeper pullback towards the next support level in the high 40,000s. So that's what they said, the high 40,000s. That's not me, right? And then, we've got Standard Chartered, who, is the king of just data, or the king of these, I guess, pullback levels, the king of this stuff, right? So Standard Chartered has predicted anything from 250,000 down to now 50,000. So take their predictions with a grain of salt. But just 2 days ago, they revised their forecast to fall below to 50,000 before any recovery. And they cut their year-end target from 150,000 to 100,000. So they're telling their clients, hey, look out. We're going to stay in this 50K range for a little bit. And this isn't fringe. This is mainstream institutional forecasting. This is what these big banks are telling their clients. So we're $10,000 away from 60K right now. And that's where the tripwire is. And we just rallied to 70K on the lowest volume in month on a weekend with no institutional participation. And there's a loaded gun sitting at that 60K, folks, and it's pointed at every single leverage wallet. Now, I'm not telling you guys to panic sell. I'm not telling you guys Bitcoin is dead. I'm telling you guys you need to be essentially just holding Bitcoin in self-custody and getting it off an exchange, because that's the only place Bitcoin's safe, right? If you truly believe in Bitcoin, the asset, which I think all of us do here in this chat, the price shouldn't matter. You should just be accumulating Bitcoin as much as possible. Sure, we want to get more sats for our dollar. And if you truly believe in Bitcoin, you will be doing that. But the best place to do that and hold your Bitcoin, the easiest place, I think, is at Trezor. They're actually giving you guys a Valentine's Day deal. Look at this, up to 20% off until February 15th. So make sure you guys are going to that affiliate link down in the show notes, because they're giving you guys a free wireless charger with a Trezor Safe 7. They're giving you guys 10% off this Trezor Safe 5 and 3. And then they're giving you up to 20% off on some of these bundles. So go down and show your Bitcoin a little love during this Valentine's Day. As Future says, it's the worst day because I have so many people to please. But be sure to get your Bitcoin off exchanges, because We're still seeing the institutional demand come in, but the interesting thing is where we're seeing the institutional demand come from. So, I'm staying here and saying that, hey, I'm a little wary. I'm bullish long term, but in the short term, I'm a little wary here, right? Because I think Bitcoin is about to rip. Like, I mean, I truly believe that. And I think you should be stacking on the way down, right? Because if you truly believe in this asset, I think that this is something that you should be doing. But I want to raise some caution to you guys because with this, there's one buyer, one corporate buyer in January 2026. Like you guys saw the amount of Bitcoin buying from these treasury companies, and I was covering it. I was extremely bullish on all these treasury companies because they were all coming in. Look, right? There's over 100 publicly traded companies with Bitcoin on the balance sheet. Here's the top 100. They have a full Satoshi on them, right? But when you look at January 2026, these corporation entities collectively bought 41,000 Bitcoin. So on the surface, that sounds like it's healthy. That's a lot of institutional buying, right? Because these companies are accumulating, except it's not companies, it's one company. Strategy, formerly known as MicroStrategy, MSTR, Sailor's company. You guys all know him. They bought over 40,000 Bitcoin. Of that, they bought 40,150 of that 41,000 Bitcoin. That's 97.5% of all corporate buys in the month of January. 97.5%. Not 50, 70, no, literally 97.5%. So basically all of it came from one single entity. And now they hold what? Like, what does it say up here? 714,644 Bitcoin. Sure, their MNAV's right around 1, but this is 3.4% of all Bitcoin that will ever exist. One company holds all of that. And they're currently down 4.5 billion on their total investment. Sure, Sailor has said they'll refinance the debt, all of these different things, but they're still 4.5 billion underwater. And this week alone, Sailor bought another 1,142 Bitcoin for $90 million. And he'll keep buying. I'm not saying that he won't. I definitely think that he will. And he has 8.2 billion in convertible debt outstanding. His stock price has been falling though with the Bitcoin. And this window to raise new capital keeps getting smaller every time Bitcoin price drops. And sure, he has a bunch of cash to be able to pay, his dividends out. But I think this is something that we should be keeping a close eye on because I do have faith in Sailor. And I mean, I think his ability to financially engineer a lot of things has been, you know, advantageous and admirable to say the very least. But what happens if Sailor can't raise any more money? What happens if the debt markets tighten? Because we get a hawkish Fed chair, Kevin Warsh isn't going to come in and quickly cut rates like maybe everybody thinks. The debt margin tightens and his stock price continues to drop too far where he won't be able to do another offering. Then the music just stops. So that one institutional buyer that's been like holding this market together essentially would disappear. Volume would be down 30%, 6 billion gone from these ETFs. Goldman Sachs cutting its position. The basis trade still loaded in the system, and Michael Saylor is not selling, but he's not buying at the amount he is. And I'm not saying strategy is going to fail or anything like that, right? I'm saying that this market's being held up by one buyer essentially right now because we aren't seeing some big guns come in. So this is what we know, right? Volume has collapsed 25 to 30% on the trading desks. 6 billion has left the ETFs. Goldman Sachs is cutting the position. The February 5th crash was caused by institutional leverage unwinding. And there's 150 million in the sell side liquidity stacked between 70 and 75K ready to reject this rally. So the 60K is still a tripwire. If it breaks and will fall below, the next is right above 40K. Oh, and one more thing, the crypto fear and greed index, the Bitcoin fear and greed index, I love to show this. It's at 8. It's at extreme fear. So the market is still very scared. And look, I mean, Warren Buffett, one of the greatest investors of all time, says in markets like this is where you buy, right? When people are fearful, this is where you see as a positive and a buying opportunity. And that's personally what I see as well. Like I really do believe that this is where we could see, this rally, come sooner than people think. And I think people are going to be a little bit fearful right now. And look, I mean, with great concern, I think we should be. And some people might be cheering for that 30K gang, but I'm telling you guys, don't wait around. Don't be so bearish that you're just saying, we're toast. We're not going to do all this. All right. I'm done with Bitcoin. But I just think that there's 20 to 30% down, right? At the end of the day, this is reality. This is what the data says. You can do with that what you want, but I'm still bullish long term. I think we're going to make it, folks. We just might have some short term volatility. So I'm going to be covering it all here. So make sure you guys are subscribed to the channel. Hit the like. Let me know in the comments what you guys think of this data. Tell a friend to tell a friend. And have fun celebrating the worst day in Valentine's Day, because I got too many women to please tonight, folks. I'll catch you guys all at the next one.